Picture this for a second. You've just hit a massive subscriber milestone. And to celebrate, your absolute favorite brand sends you this huge, beautifully wrapped PR package. You know, maybe it's a luxury skincare hamper, or maybe it's the latest flagship smartphone. It feels amazing, right? Like you have finally made it. You unbox it on camera, your audience is eating it up, and it really just feels like the ultimate free perk of the job. But, well, here is the massive reality check that catches so many creators completely off guard. Is that free PR package actually free? The short answer? Absolutely not. You see, tax agencies globally, from the IRS in the US to the Income Tax Department in India, they don't look at you as just someone having fun on the internet. They view you as a full-fledged business owner. And those quote-unquote free gifts, they're actually considered taxable income, which means that free phone could suddenly cost you a few $100s in surprise taxes.
So, welcome to this explainer. Today, we're diving deep into the complex and, kind of intimidating tax realities for digital entrepreneurs. Whether you're vlogging from a tiny apartment in New York or streaming from a full studio in Mumbai, the rules of the game have entirely changed. But hey, our goal today is definitely not to scare you. It's to empower you. We're going to decode the rules, help you stay totally compliant, and most importantly, show you exactly how to save money so you can keep way more of what you actually earn.
Here is our quick agenda for today. We'll start with 1. The creator tax reality. Then 2. What counts as income. 3. The gift and barter trap. 4. Smart deductions save you money. And we'll wrap up with 5. Deadlines and tax compliance.
All right, let's kick things off with Section 1, the creator tax reality.
So, the days of treating your content creation like some under-the-radar hobby, those days are long gone. The thresholds for the government to view you as a business are shockingly low. I mean, in the US, the IRS rule is wild. If you earn just over $400 in a year from your content, boom, you are officially classified as self-employed. You are instantly on the hook for self-employment taxes. Meanwhile, over in India, if your annual turnover crosses 20 lakh rupees or just 10 lakhs in certain special category states, registering for GST isn't just a good idea, it's literally mandatory. The second you hit those numbers, you cross the line from hobbyist straight to CEO, and that makes you strictly liable for business tax rules.
Moving right along to Section 2, what counts as income?
We really need to break down your revenue streams here, because in the creator economy, income doesn't look anything like a traditional 9-to-5 paycheck. When you're a creator, your income is just this massive, diversified web. It's not just that one big brand deal you landed last month. Everything counts. We're talking YouTube AdSense, Instagram Reels bonuses, Twitch bits. It includes your Amazon affiliate payouts, your monthly Patreon subs, and even direct stuff like selling your own digital courses or Lightroom presets. Every single trickle of money from every platform, it all adds up to your gross taxable income.
And please pay close attention to this because the platforms absolutely report this stuff to the government. In the US, if any brand or platform pays you more than $600 in a year, you should fully expect a Form 1099 NEC in your mailbox. And guess what? The IRS gets a copy too. Now, in India, it's arguably even more complex. Payouts from places like YouTube or Twitch usually come from Google Ireland or US entities. So this isn't just regular income, it's classified as foreign income. That triggers strict FEMA compliance. You actually have to go to your bank and procure a foreign inward remittance certificate just to prove the money entered the country legally.
Which brings us to Section 3, the gift and barter trap.
Let's define exactly what is happening when you get a freebie. The key term here is fair market value. Simply put, that's the normal selling price of a non-cash benefit. If a tech brand sends you an $800 camera to review, or a beauty company ships you a 15,000 rupee skincare routine for a reel, you do not pay zero tax just because there was no cash involved. You pay tax on its fair market value. In the eyes of the taxman, it's exactly the same as if the brand handed you $800 in cash and you walked into a store to buy the camera yourself.
And honestly, both countries have really cracked down on this recently. In India, under Section 194R, there's a 10% tax deducted at source on freebies valued over 20,000 rupees. The brand literally pays this tax on your behalf before they even ship the gift, and it gets tied directly to your PAN card. In the US, the IRS is super explicit. Barter exchanges are fully taxable as regular business income. The takeaway here, both governments are meticulously tracking these shadow transactions. Brands are writing off the value of these gifts as business expenses, so if you don't turn around and report them as income, the tax authorities are going to spot that discrepancy immediately.
All right, deep breath. Let's look at Section 4, smart deductions save you money. See, it's not all doom and gloom.
Because you are officially a business, you actually get to write off the costs of running that business. By keeping track of your expenses, you drastically lower your taxable profit. You're only paying tax on what is left over. Did you buy a new camera, some hard drives, a ring light? That's deductible. Do you edit in a home office? You can deduct a portion of your rent, your internet, your electric bill. Flying out to VidCon? Those flights and Ubers are deductible. Even the money you pay your freelance video editors or thumbnail designers, it all reduces your tax burden.
And lowering that net profit is absolutely essential, especially in the US, because of this number right here, 15.3%. US creators don't just pay regular income tax. You're also hit with a hefty 15.3% self-employment tax. That covers Medicare and Social Security, basically because you don't have a traditional employer covering half of it for you. So every single dollar you can legally deduct through business expenses, it shrinks the profit that gets slammed by this massive tax.
Meanwhile, in India, deductions give you a totally different superpower, GST perks. If you're registered for GST, which sits at 18% for content creation, you can actually claim an input tax credit. So when you go out and buy that new lens or pay for your Adobe Creative Cloud subscription, the 18% GST you paid on those items can be reclaimed to offset the GST you owe the government from your brand deals. It literally keeps cash flowing back into your business instead of leaking out.
Finally, let's wrap up with Section 5, deadlines and tax compliance. Okay, so how do we handle the actual logistics without losing our minds? Here's your simple step-by-step survival guide. Step 1, and please don't skip this, stop mixing your personal and business money. Open a dedicated business bank account today. Step 2, automate your bookkeeping. Step 3, this is the real game changer. Habitually transfer about 25 to 30% of every single payout into a separate savings account just for taxes. Out of sight, out of mind. And step 4, make sure you're filing the correct forms, like an ITR3 in India for a standard creator business, just so you avoid triggering any automated nastygrams from the government.
Also, keep in mind, the government does not want to wait until the end of the year to get its money. If you're self-employed in the US and you think you're going to owe more than $1,000 in taxes, you have to hit these 4 quarterly estimated tax deadlines: April 15th, June 15th, September 15th, and January 15th. Miss those dates, you're looking at painful IRS interest and underpayment penalties before you've even filed your annual return.
At the end of the day, keeping your receipts in a random shoebox just won't cut it anymore. Using a professional bookkeeping service, or even just some robust accounting software, is your absolute ultimate shield. It keeps your records totally spotless, it ensures those estimated payments are perfectly calculated, and it guarantees you aren't missing out on deductions you rightfully deserve. Clean books mean zero panic attacks when tax season rolls around. So I'll leave you with this one final thought. Are you leaving money on the table by missing out on completely legitimate business deductions? Or honestly worse, are you accidentally inviting an audit by ignoring the value of freebies and foreign payouts? Look, the creator economy is a massive, real industry, and you are running a real business. Take control of your finances and your compliance today. Because once you get this system dialed in, the stress just melts away, leaving you to focus entirely on what you actually do best, creating amazing content. Thanks so much for joining me for this explainer, and I'll catch you in the next one.